You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
Hello, everybody, and welcome back to the Advisor's Option, the program for financial advisors and asset managers who are interested in learning more about how to implement options into their clients' portfolios, as well as those of you out there who are the clients who want to learn what they should be looking for in an advisor or asset manager, particularly from an options perspective. My name is Mark Longo from the optionsinsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network, a baker's dozen worth of programs for you guys to choose from on said network, including many, many archived and interesting episodes of the Advisor's Option for you guys to check out. And where can you find all of those archived episodes as well as all of our other programs? Well, of course, the flagship, theoptionsinsider.com. That's where we host all of our programs, as well as a lot of other very, very interesting content, if I do say so myself, from the world of options, education, analysis, what's going on in the options world, breaking news from the options world, unusual activity, all that fun stuff, as well as all of our 13 programs. You can find all the episodes there. If you want the audio, you can also just find it iTunes, Stitcher, Aha Mobile, wherever you find your favorite podcast programs. I encourage you to check it out. We have a lot of great archive episodes. If you got some time around the holiday season or into the new year, you want to prep yourself, give yourself a nice little overview or refresher on options, then the archived episodes of the Advisor's Option are certainly the place to go. Of course, we've also made it even easier. We've baked it all into our mobile app, available for iOS, Android, even the Fire OS. So you can just find all the episodes there, as well as interact with the show hosts there, send us questions, comments, feedback, all that fun stuff. We love to hear from you here on the programs. And joining me on the old Advisor's Option today, first off, beaming in, this time not from scenic and warm Puerto Rico, but from a little bit chillier Colorado, but still a good place to be if you want to do some skiing. He is Randy Swan. You knew him and you loved him as the co-founder of Swan Wealth Advisors, now the president of the newly rechristened Swan Global Investments. Randy, welcome back to the program.
It's great to be here, and it's great to be on the program for the last time during 2014. it is an awesome change coming back to Durango, where the temperatures are much cooler, but you get to enjoy the snow. So I've been doing a lot of skiing this last week.
Yeah, your blood must be a little bit thinner after having lived in Puerto Rico for a while. So it must be a shock to your system getting back to the chillier climes of Colorado.
It's definitely an adjustment. I've lived in Colorado for almost 20 years, and so the last 9 months I've lived in Puerto Rico. So it's we'll see. I think maybe every year I live down there, it may be harder to come back here and enjoy the cold weather.
Well, get the skiing in and enjoy it while you can. And we are also joined here on this final episode of 2014 by the principal over there, the major domo over there at RCM Futures and RCM Wealth Advisors, Mr. Mike Cavanaugh. Mr. Cavanaugh, welcome back to the program, sir.
It is great to be back and welcomed. I am not as in a location as glorious as Durango, Colorado. I am here in Chicago, where it's a blistering 9 degrees, no snow, and really no outdoor activities to enjoy in the urban setting that is Chicago. But lots of holiday bustle.
9 degrees. Hopefully we're a little bit warmer than that. But yes, you're right. A lot of holiday bustle here in the downtown Mecca that is Chicago. So we'll pick your poison. You could be in Puerto Rico. You could be skiing in Colorado. You could be in the urban metropolis here in sunny Chicago. Wherever your travels take you, we welcome you here to the Advisors Option Program. And as you said, it is indeed our final episode of 2014. So we thought, what better thing to do on this final episode here of the year than take a look back at the year that was from an options perspective? What were some of the big developments, the big stories, the big things you, as an advisor, asset manager, should have been aware of throughout the year? We'll debate and discuss some of those, as well as some of the misperceptions that may have come out of 2014. And then if there's some time left at the end, we'll look ahead to 2015 and tell you some things you should have on your radar for the coming year. So without further ado, let's dive right into our 2014 year in review.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, welcome to The Buzz. This is usually the segment where we tell you what's happening in the options world right now, but we're actually going to have a little bit further back purview, like I mentioned on this episode, go all the way back to the beginning of 2014 and kind of break down the year that was from an options perspective. There's a lot of different places we could start, but I thought we would kick things off by tossing it to each of my panelists here to get their reflections on what they think were the salient, most top-of-mind development stories, issues coming out of the world of options here in 2014 that you, the listener, should be aware of. Mr. Cavanaugh, perhaps we'll start with you. And I look at you and I say, let's look back at the year that was in 2014 from an options perspective. What really comes to mind? What do you think our listeners should have been aware of in this past year?
Well, there's a couple of different things that jump out at me as far as the year in review, looking back. And it's interesting for me because I used to be, 5 years ago, even 2 years ago, just, on the desk managing the strategies. We now have a full-blown investor policy committee that handles the investments at our shop. So I'm not as involved in the day-to-day decision-making with the different strategies we apply. I'm more out in the goodwill ambassador mode, just meeting with clients and meeting with prospects and meeting with other advisors. And what sticks out to me in 2014 is something interesting, is the change of perception. Maybe not perception isn't the right way to put it. The willingness for advisors to learn more about options really coming from a client demand. Prior to 2008, options were more closely related to a 4-letter word in the advisor world. But now it seems that more advisors are receptive to educating themselves on the proper usage of options. I think it's triggered and spurred by the ongoing, resilient, and remarkably low yield environment in investor portfolios that investors, the clients of the advisors, are starting to look into the world to find alternatives to, their traditional type of wealth management relationship, and the advisors are reaching out. And I know our friends from the OIC aren't with us today, but, just being involved with the OIC on their advisor council, I know Randy's on that council as well. They put that council together because they're getting more and more advisors coming to them that are asking questions about options, and they want to be able to connect them with advisors that have been doing this for a while that can help guide them and educate them on the proper usage. So that's what stands out to me the most, is the action the OIC took to create the council, as well as the demand and the different events that I've attended to meet all these different advisors that are saying their clients are asking questions about options. And you hear that, I've heard rumblings of that in the past, but when you see it and you participate in it, it's more real. And I equate it to the low yield environment, but I think options are becoming more and more integrated into clients' portfolios.
Well, that's certainly music to our ears here on the Advisors Option Program. Hopefully we are some small part of that surge. But you're right, it has been an interesting sea change to watch develop over the past 12 months in particular. A lot of resources really coming to bear, aimed directly at the RIA/financial planner/asset manager/whatever acronym you want to throw in there, really for an options-oriented perspective, to get more of them to become aware of this space, to start allocating resources to this space. Because you're right, it is a low-yield environment. It is an ideal opportunity to start incorporating these tools and these products into your portfolio. If you're not doing it at this point, really, you are probably, in many respects of the word, doing something wrong. Randy, you obviously talk to a lot of advisors across the country. Have you seen this anecdotally as well from your travels and your various events you go to? Are you seeing more advisors starting to drink the options Kool-Aid, if you will, and really starting to become more willing to come to the dark side, to throw yet another cliche in there, from an options perspective?
Absolutely. I would second Mike's view. I think this has been a process that's been a lot longer than obviously just a year, but my evidence or my experience is that, a lot less frequently when people come to us and potentially want to use our services as money managers, have a problem with options. So I think it's been a dramatic change over the last 5 or 6 years. We've continued that trend, offering new products, offering new strategies for various types of clients, and more customizable solutions to whatever they want. So rarely do I run into people that say, no, I'm not going to use someone that uses options anymore, or a strategy that uses options. I know those people still exist, obviously, but it is much less frequent at this point.
So Mike says his takeaway from 2014 is really the growing willingness of advisors and asset managers to embrace this product category. Randy, as you look back on 2014, what is really top of mind for you from an options and indeed an advisor asset manager perspective? What were the big developments, the big stories, the big trends that you noticed that you think our listeners should be aware of?
Well, just as it relates to the market, I would like to maybe have some commentary on the market. If I would have looked forward in 2014, a year ago, and said, what do I really see going on in the market? We've had this bull run since the lows in March of 2009. And every successive year, you kind of wonder, okay, is this going to be the top? I mean, I think that from my perspective, we're not in the business of making market calls. We have a strategy that we implement, rain or shine, as it were. But I think it's interesting to watch the slight change of mentality, or maybe the mood of the investors seem to be pretty bullish at this point, which obviously gives me some caution in terms of, are we getting close to the top? I know from a strategic perspective as a firm, we're very happy. Anytime I get to the end of the year and have the market up double digits, being able to lock in those gains by rehedging our portfolios, which we're actually doing this week at our firm right now, I always get pretty excited. And knowing where the S&P 500 is, the level it's at all-time highs, basically, that makes me even more excited given and also the relatively low volatility level of the market. So I feel like insuring portfolios is extremely cheap right now, relative to historic standards. So we're pretty excited about moving forward to 2015. Of course, don't know how that's going to turn out, but we're ready for whatever comes our way.
Certainly has been an interesting year from an overall broad market perspective. The bull market continues, this protracted bull market period that we're in. A lot of people might traditionally think that might be actually detrimental to options. A lot of people think, well, I don't need to use options. I'll just buy and hold my underlying and I'll knock it out of the park. And then that certainly is the case. You did do all right this year if you just bought and held the S&P or some other broad indices or some other largely widely held products. But as Mike said, and as Randy alluded to, there are a lot of other use cases, particularly in the yield area and the income and protection areas of the market, that really options are singularly useful, and a lot of people are really starting to discover that. And you're right, Randy, from a volatility perspective, it certainly was an interesting year as well. So maybe we'll dovetail from there into some interesting misperceptions that we saw coming out of the year as well from an options perspective. Since you mentioned volatility, I think we'll start there. There was this persistent drumbeat that was going on throughout the year. If you watch CNBC at all this year, listeners, particularly in the middle part of the year there, or looked at a lot of other broad financial media, you heard this drumbeat of the VIX is too cheap, volatility in the marketplace is simply too cheap. And that was particularly in the realm when the VIX cash started getting down into the low teens range, in the 12 to 13 range earlier this year. We saw this drumbeat really starting to pick up, and the notion that volatility is mean reverting, therefore it has to revert back to its long-term average somewhere in the 18 to 20 range. We heard a lot of that. But the truth is, first off, before we even get into that, a lot of different things to debunk there. But first off, when you look at it just holistically from a volatility perspective, of course, what they're talking about, what the VIX cash measures, is indeed the implied volatility of the SPX options, the S&P 500 options out there. So that's showing you essentially the implied volatility of that product. And we know implied volatility is essentially the market's best guesstimate of what volatility is going to be in the duration of that contract. So whenever there's a guesstimate, there's always going to be a fudge factor built into it. There's going to be a little bit of fluff, a little bit of added padding to make your guesstimate have some wiggle room. So just by definition, implied volatility is typically always going to be higher than the actual volatility that's exhibited in the marketplace. It's what we call the risk premium in the marketplace. And the interesting thing to take away from 2014, and perhaps debunking that vol is cheap myth a little bit, is that even on those periods when VIX cash was at its lowest, which was the 12 to 13 range, happened a few times this year, we saw in most of those periods, at the same time that the implied volatility levels was hovering in the low teens, the actual volatility, the realized or historical volatility in the marketplace, was typically in the 5 to 6% range. So you're talking anywhere from a 7 to 8% premium in the marketplace, even at the lowest point, the nadir of the implied volatility, so-called, in the broad marketplace. There still was a very large and perceptible and capturable risk premium in the marketplace. So that's something to just keep in mind if you're out there and you're learning more about options and volatility, and you hear these drum beats start to pop up in the media that things are too cheap, that things are not cheap. Remember, there is indeed the implied volatility in the marketplace, and then the realized volatility that we're seeing. And then when there's still a large discrepancy, there still is room for that risk premium in the marketplace, and there still is room to capture that. So just bear that in mind when you're trading. That don't come away from 2014 thinking things were too cheap for the entirety of the year, because actually when you price them from a realized volatility perspective, things were actually still a bit overpriced, which is, I think, a surprising takeaway for a lot of people. Randy, you've heard this drumbeat a lot. You obviously pay a lot of attention to volatility out there in the S&P because you're doing a lot of your overlays. Was that one of your takeaways as well, that people would just move away from this VIX is cheap thing and really start roping in the notion of what's actually happening in the marketplace versus what things like the implied volatility gauges like VIX are actually pricing into the marketplace?
Absolutely. You always get into, I guess one of the issues that I'd like to discuss is we just don't know really when volatility, even though it's relatively cheap right now, when it's actually going to revert to the mean and go much higher. So, that's one of the games that if any of us knew what was going to happen, then we would obviously be able to make a lot of money doing that. So I just look at it as a game and say, you need to go out there and be prepared no matter what happens, and take what the market gives you at that point and design your strategies, whether it's an investment management strategy or it's a trading strategy that you're employing, to take advantage of what the volatility is actually out, knowing that you're not really going to know when the market or when the volatility may increase or pick up, over the next several years. I mean, we probably would all agree at some point it probably will. We just don't know, of course, when that's going to be.
Yes, volatility and the VIX are certainly prone to these wild, dramatic swings. Perhaps another takeaway from 2014, volatility has a volatility, and that's something we saw exhibited very, very dramatically, particularly in the last third or so of the year, particularly post-October or October on, when we really saw very dramatic changes in the volatility in the marketplace. Things like the VIX itself were swinging dramatically, and the implied vol of the S&P was really moving dramatically. So another thing to be cognizant of as we finish up the year here in 2014 and go into 2015. Mr. Kavanaugh, obviously volatility, a very interesting, very hot topic. A lot of misperceptions floating around in the marketplace from an overall vol perspective. What would you have to share with our listeners from a vol perspective, looking back at 2014, maybe some of the takeaways from last year and things they should be aware of?
Yeah, it's always interesting to talk volatility, especially with advisors, because you have to talk about the relevance of volatility to the advisor. Most advisors we encounter that are looking for, exposure to the options market, we try to educate them on what their expectations are. Really, we're not using volatility as one of the determining factors of managing a strategy, as much as a strategy like a collar is meant to hedge volatility. Whether the volatility is low or high, you maintain your strategy throughout the course. So when vol's up or when vol's down, if you're instituting a strategy that's meant to hedge the long-term volatility of the actual investment return over a 10, 15, or 20-year period, it's kind of like you have to throw volatility out of the equation, because it doesn't play into the downside protection that you're actually looking for. And your trade-off is you're giving up some of the upside, at least in a collar strategy. So I know that like the main component of pricing of an option is volatility, but as far as relevance to an advisor that's looking to hedge a client's portfolio using options, volatility becomes almost a moot point.
Oh, I was just going to say, I agree with Mike. At Swan, we hedge portfolios over the long haul, and so you really, you would like everything else being equal. You'd like your insurance, portfolio insurance, to be cheaper and more expensive, but you have to accept what the market is demanding at that point in time. But I think it's just over an entire investment cycle, a bull and a bear market cycle. You expect to kind of get an average cost of that insurance that, we think over time is pretty reasonable. I think that's the perspective that Swan has, is a much longer term view than trying to take advantage of whatever perceived hedging costs there are today, knowing that a year like 2008, 2009 was extremely expensive to hedge your portfolio relative to it is right now.
Yes, at the end of the day, it's all about your end cost, and if that's lower and it's cheaper and it's easier to put on a hedge, then that's a good thing for our audience, certainly. Speaking of these comparatively relatively lower levels of volatility, a lot of people had that perception in 2014. A lot of people therefore assumed that 2014 would be a very light year from an overall options perspective, overall options volume perspective. And that actually turned out not to be the case. If you look back at the year was really bookended by two very dramatic periods. We had the beginning of the year where we had the Ukrainian crisis getting into Q1, early Q2, and that really generated a lot of volatility, a lot of movement in the marketplace, and of course a lot of options volume. And then of course, once October rolled around, the rest of the year was pretty active. November, a little bit less so. But October and December, certainly active periods in the marketplace. So with those two bookended periods really accounting for a lot of volume, this year turned out to be a fairly robust overall volume period. In fact, looking at the numbers here from the Options Clearing Corp, which is, of course, the parent company of our friend, the parent arm of our friends over there, the Options Industry Council, who join us on this program regularly. And their numbers here, these are coming in from November. We still have a couple of days left in the year here, listeners. We're recording this on December 30th, so we don't have the exact numbers for 2014 in the books yet, but as all things being held equal, all things considered, this is on par to be the second busiest options year ever behind 2011. They're on par to do probably about 3.8 or so billion contracts this year, which is ahead of last year, ahead of 2012, which were 3.72 and 3.68 billion respectively. 2011 being the only year in recent history that, or any history really, that surpasses that with about 4.2 billion on the equity options side of the fence, of course. So very, very robust numbers this year, which I think came as a surprise to a lot of people who were expecting that this would be a bit of a light year, because when volatility is low, as you guys know out there, of course, it's an incentive to buy options, but a lot of people out there are really utilizing options to generate income, particularly on the advisor side. And when volatility is on the lower end of the spectrum, there's less incentive for them to come out and actually sell those options. So a large portion of the options volume tends to go away. And we didn't see that this year. We had enough volatility, enough volume in those stark periods of the market to really make up for any of the doldrums we experienced in the middle of the year. Randy, did that come as a surprise to you that this year was so robust overall from a volume perspective, or did you pretty much expect that going into the end of the year?
No, I guess I actually expected, just from the topic we talked about earlier, if there's more people that are interested in using options, I think a lot of people, including our firm, are not out there trying to make a play because we think certain events are going to change something. We have more money to put to work. That's because there's more advisors that want to use managers that use options. So I think that there should be a continual uptrend in the use of options. And obviously, when you come into certain types of years where there's dramatic events that occur, yes, they may spike up even more. But no, I absolutely expect the trend to continue, especially in this interest rate environment where people are looking for alternatives to your traditional, I'll say, kind of 60-40 portfolio. When fixed income is in a situation where it's very hard to get much upside from investing in fixed income at this point. So, no, I'm not surprised at all.
Mr. Kavanaugh, same question for you. Was that a bit of a surprise for you that this year turned out to be as much of a blockbuster year from an options perspective as it turned out to be? Because it seemed like earlier in the year that was not going to be the case.
Yeah, no, my comments mirror Randy's. I think anytime the demand goes up in a marketplace, I think we're seeing a different, like the volumes coming from a different place. Like in 2011, 2009, 2008, I think the usage of the options market was spurred by volatility. I think we're seeing a demand-driven volume, and the crazy part about it, and I wish Alan or Eric were on the line because they did a lot of work just in bringing access to the marketplace. One, educating advisors and, in the United States, but, the exchanges are now becoming more and more global in the listed options arena. And I think if you look at the demand-driven volume, I think it's going to skyrocket with the new relationship between the Shanghai Exchange and the different options exchanges, BATS and NYSE, and all of them in the United States. So I think that demand's going to continue to skyrocket, and the demand driving the volume. I think the volume's going to continue to grow, not as necessarily based on as much as a volatility is, but like Randy mentioned, the demand. More people are wanting options. More people are using options.
You're right. One of the big stories of 2014 from a volume perspective was supposed to be the entrance of China into the listed options realm. We didn't really see that materialize. It was supposed to happen back in April as a variety of things conspired to delay that. I'm hearing talk now of sometime next year, perhaps at the earliest. It seems like the Chinese government really trying to put the brakes on that for a variety of reasons. They're scared of options. They have a bit of an antiquated perception of options, as some people here in the States still do, that options are perceived to be risky and risk additive instruments, not risk hedging, risk mitigating instruments. So they're trying to put the brakes on them, do some things to really constrict their adoption in the marketplace. So we'll see if that unfolds in 2015. Whenever they do finally pull the trigger over there, that will certainly be a huge driver of global demand for all sorts of listed equity options and index options, and it certainly will be interesting for a lot of people in these marketplaces to see how that demand shapes things going forward. Another thing we saw coming out of 2014, probably a bit of a misperception, is if you look back at the year, you see, it was a bull market year, so really all I need to do from an options perspective is just kind of load up on some out-of-the-money calls and I'm going to hit a home run. I'm going to do great. And that's certainly a bit of a misperception from the year. Certainly if you bought calls, on aggregate, you probably did all right, particularly if you bought the meatier ones. But unfortunately, a lot of people tend to migrate towards the out-of-the-money part of the options chain. And as we said on this program, many other programs on the network, that's a difficult road to hoe to be consistently profitable over the long term. Remember, those are options that have essentially nothing but time premium in them, so they decay very rapidly. They're very subject to decay. And of course, the year we had this year, if you look at the chart, it wasn't a sharp spike upward, except for a few tumultuous periods there in the marketplace. It really was more of a gradual upward movement in the marketplace. And in those types of environments, those out of the money calls actually may not perform as you expect. They are, of course, cheaper from an implied volatility perspective. As you move up that volatility skew, as you move up the option chain, that implied volatility actually becomes cheaper, not more expensive. That doesn't work in your favor. And if the move doesn't happen in the required amount of time, you could actually suffer a lot from time decay before that option even budges a penny to the north from an upside perspective. So it is conceivable to have someone come in and bought maybe quarterly options this year on the out of the money perspective, and then ended up not perhaps doing as well, or perhaps underperforming from their own perspective. So don't just look at this year and say, oh, it was a bull market, and all you need to do is just buy some out of the money calls and you're good. It really is a much more nuanced approach than that. We've always counseled on this show utilizing spreads, a much more risk mitigated approach to the marketplace, using vertical spreads in that scenario whenever possible, rather than just loading up an out of the money call. So buying at the money, selling the out of the monies, taking advantage of all the things we talked about here on the show, mitigating your premium outlay. So if you come away from 2014 thinking, I just need to go buy some calls and I'll do all right, and I'll win and I'll beat the market, it's not necessarily the case. There really is a little bit more nuance to that. Randy, would you concur on that this is not just a year when you can just go out and just buy calls and put them in your back pocket? You really need to do a little bit more, as you say on one of our other shows, do some stuff out there to really make sure that your options portfolio succeeded in 2014.
Yes, I would agree with that. And I think the bigger picture perspective I would just add is, I think any successful trading program or investment program has to have multiple strategies built within it. So you can't rely on one type of strategy to work all the time, obviously. And so diversification in this instance, I think, is necessary. And so, this was not a huge, I wouldn't consider 2014 a great year for a lot of premium to be able to make per se. But of course, if you've got long equity exposure to the market, then you're very happy about what's happened in the market this year. Just gives you different examples of how over time diversification in terms of your option strategies and how you allocate assets within that program is something that I think is necessary to weather whatever short-term swings or whatever environments that actually pop up, over a shorter time period as opposed to a full market cycle.
And Mr. Kavanaugh, you guys obviously interact with a lot of the retail spectrum over there on the client perspective. Have you seen this mindset starting to seep into them? Perhaps a dangerous mindset from an options perspective. They're coming in saying, hey, just load me up on whatever cheap calls I want in SPY or name X, and we'll certainly do all right. Have you started to see this creep into the marketplace as well?
Yeah, you're never going to get rid of it. It's the speculative nature of leverage, and your eyes looking at how much money you could make with how little you have to risk. And when I'm confronted with that, whenever I'm talking to anyone, I always tell them that thank you for the compliment, but the waitresses in Las Vegas are a lot better looking than me, and the drinks are free. So when you have a trading strategy that's purely speculation, it's a tough thing for me to understand unless you have like some sort of systematic risk management where you're algorithmically or statistically getting into these long out of the money calls. It just seems like you have to be right on so many different things: direction, the force of the direction over a certain period of time. I mean, you're kind of stacking the odds against yourself if your strategy is purchasing long out of the money calls. We don't see it as much, but we don't really have a book of speculators as much as we have people that they know enough to get themselves into trouble, and before they do something, they generally call to bounce an idea off of us, and we kind of view it as our job to give them an alternative suggestion, saying, well, that's one way to do it, is to buy a ton of out of the money calls and kind of hope that you're right in the force of the direction over the time period you select. Or, you could take another look at maybe purchasing in the money call, putting maybe fewer contracts in play, maybe risking the same dollar amount, but having a better chance of catching some upside. Is kind of what we view our role as, is to keep people aware of the risk to reward scenario with options and everything you have to be right on with the out of the money calls. Sure, we all hear the stories, and the educators in the marketplace that sell newsletters always, they boast about these 4,000% returns overnight on an earnings. Is it possible? Sure. Is it completely speculative? Absolutely. And, if that's what somebody wants to do, and they've gone through at least a topical education conversation with somebody here, one of our advisors, then, if they understand it's speculative and all the money that they put into that particular trade or strategy could be lost, and they're comfortable with the amount, we're not going to tell them not to do it as long as they understand, they might from time to time make some money at it. So, and Randy touched on it. I mean, there's a huge difference between investing with options and trading with options. And we tend to lean more towards the investing with options. And that just kind of naturally keeps the speculative out of the money call purchases, unless it's a hedge, like you mentioned earlier, to a spread where you're short and at the money call and you buy a couple of out of the money calls, just as a way to hedge the upside, if there is a big move, like a back spread. But other than that, we don't see a ton of the out of the money pure speculative stuff. I know that was a long-winded answer.
Well, that's good. That means you guys are doing your job. You're educating those masses out there, so they're not just diving into the fray whole hog. Just wanted to point it out there because I know there's a lot of people who still have that mindset, and perhaps they took that lesson away incorrectly from 2014. Now, looking back on 2014, if I had to say the one really surprise story for the year for me, it has to come a little bit outside of our normal purview on this show, outside of the equity and index options realm. For me, the surprise options related story of the year, and surprise market story of the year probably too, was the dramatic events, the dramatic turmoil we saw in the oil part of the marketplace, the oil sector, particularly over that latter quarter there of the year. And not typically an option story that we would talk about with advisors, and yet this year that certainly was the case. Oil was pretty much top of mind for everyone going into the latter part of the year. It exhibited some of the most volatility we've seen of any product out there these days. A lot of options volume going up as a result out there in the oil sector. Of course, oil just taking on the chin in the latter half of 2014. It hit its high back in June of this year. I believe it was June 20th. And since has just taken on the chin, just hit the 50% mark just a few sessions ago. So oil has now been cut literally in half since its high of 2014. So not just didn't take several years for that to happen. It happened in less than one calendar year, half of a calendar year. It was actually the fastest period, the fastest we've seen oil get cut in half in ages and decades. This, of course, what we saw, this recent settlement is the lowest we've seen oil trading since May of 2009. So you look at the different record, the different benchmark, and oil seems to be hitting it on the downside these days. We've, of course, have discussed it on many of our programs, our volatility programs, our trading programs, even on this program a bit. We did a recent episode on futures options as a result. A lot of people, a lot of advisors, clients, and others are really starting to pay more attention to this sector from an overall option perspective. We've seen a lot of interesting developments in the volatility skew out there. A lot of people were looking at the volatility skew about a month or so ago and saying, wow, this seems to be very overdone. People are paying a lot for these very out of the money puts in the 65 handle or so range, 60 handle range, back when oil was trading in the mid 80 handle range. It seemed like a lot of the bearish move had been spent, and then lo and behold, we were all wrong. Oil had a lot more downside to go. Those put buyers, while extreme, it may have actually worked out for them in this scenario. Of course, we're starting to see the reverse of that now. Oil has become so cheap. We're seeing speculative call traders starting to come in and flocking into the upside of the oil arena to try to speculate on perhaps a bit of a bounce going into 2015 in this product. So a lot of life, a lot of action, a lot of volatility in this product, and certainly, at least for me, the surprise option story of 2014. And if all things are equal, it looks like it's going to be a big story in early 2015 as well. Randy, what was your takeaway from the oil developments we saw? I know it's not traditionally an area we talk about, but it certainly became top of mind for everyone towards the end of last year. Are you starting to see more interest from the people you work with on this space? And I know you guys are talking about applying your methodology to other areas. Are you starting to maybe weigh a foray into the oil side of the fence?
You know what? We don't really have any plans on doing something right now. I'm very interested in what's happening with oil. I guess the bigger picture for us is, what does this really mean? Obviously, I think we all like lower gas prices at the pump and indirectly lower prices theoretically on other goods and services we buy. But obviously the concern on the other side is, what does this mean for the broader economy? Is this signaling something that may change, may be foretelling some type of slowdown, recession, whatever going forward? I think that's more my perspective on what the implications are from an economic perspective. On the trading side, obviously anything like this in volatility is awesome to do in these types of strategies that we do. But at this point, we're not going down that path. Someday, possibly, but in the near future, we've got a lot of things that we're working on right now to launch before oil, something that relates to oil.
Yes, certainly it was an interesting sector. You probably could do a whole show just on oil. Mike, I'm sure a lot of the clients and people you work with over there at RCM on all sides, on the wealth management side as well as clearly on the future side, we're probably very oil obsessed. I'm sure probably for you it was probably a surprise options story as well. What was your takeaway from what we saw going on in the oil world from a volatility and an options perspective, as well as what you're hearing from your clients and the people you work with over there at RCM?
Yeah, I mean, like on our wealth management side and the equities, almost the same sentiment as Randy. We had almost a 10-foot pole approach. We weren't touching it. Didn't have any exposure in our equity portfolios with any of the oil ETFs or oil stocks, and there was no real compelling interest or reason to hop in at the levels where they are. And if it continues lower and maybe triggers something, maybe there's a play to have a longer term holding in like an equity ETF that like a USO or something that gives you exposure to the oil. Probably a lot more action on the future side where they have, institutional clients as well as individual retail traders that have exposure to oil. And, when the volatility gets that high, it's the swim at your own risk. There's no lifeguard. It gets extremely tight in the margin department. And usually if you're just going in and day trading, if you're not picking your spots and keeping the risk tight, it usually doesn't work out. So it's all about managing emotion and expectations in a volatile market like that. And with commodities, what people forget is it is a zero-sum game. So for every dollar that's lost, there's a dollar made. We didn't touch it. On the equity side, I'm sure the futures guys they could probably write a book about all the stories, both good and bad, when a market gets that volatile.
Yeah, I'm sure we'll be revisiting this topic on this program as well as many other programs on the network going forward into 2015. Speaking of 2015, we got a few minutes left here on the old program, so it's time to maybe switch gears from looking back to looking forward into the year to come of 2015. A lot of interesting things to talk about there. Maybe we'll kick things off yet again. I'll give you guys, each of you, a chance to chime in, and then we'll see if we can hit some salient points going from there. So maybe, Randy, we'll start with you. What is top of mind for you going into 2015? What do you think our listeners should be aware of, should be prepared to do, or keep an eye on going into this early part of next year?
As always, I think people should be prepared for what they're not expecting. I mean, typically people are surprised, and those surprises are what cause problems in people's portfolios and their finances. So I always say plan for everything. Plan for things that you don't necessarily expect to happen or low probability events. Those are usually the ones that catch you off guard. I guess that's what I would look at, the big theme of 2015. As we said earlier, our game is not to try to time or predict the market. I obviously don't know what's going to happen in 2015, but that's why I think you always have to kind of hedge your positions one way or the other to make sure that you can weather whatever storm or whatever opportunities come up in 2015.
So beware of the unknown unknowns, as our old friend Mr. Rumsfeld would have cautioned us. Mr. Mike, same question for you going into 2015. What are you keeping an eye on? What are you counseling clients to be aware of? What do you think our listeners should be aware of going into the new year?
So I've got my own interesting theory that dates back to 2008 on what my expectations for 2015 are. In 2008, when the bailout was going on and a bunch of banks were failing, the FDIC went from like $50 billion in reserves down to like $3 billion. And Ms. Baer, who was the chairman of the FDIC at the time, said it would take about 7 years to replenish the supply in the bucket, so to speak, of the FDIC back up to $50 billion, which projected it out to 2015, which was my litmus test indicator that said that interest rates will probably stay low until the FDIC money's replenished, just as a bellwether, as a standard. So I'm watching interest rates in 2015, along with the pressures in the commodity markets. But we're seeing all-time highs in corporate cash balance sheets. We're seeing almost like a resurrection of consumer confidence. Now with the oil prices lower, housing prices are going up. It seems like people are spending a little more money on the discretionary side. They're getting the G.I. Joes with the Kung Fu grip, so to speak, for the holiday presents. So, I think it's Warren Buffett that was credited with saying, be greedy when others are fearful and be fearful when others are greedy. And I think if you see, an interest rate creep with the amount of consumer confidence, it could be, a little bit of volatility in the equity market. But that's the great thing. If you're using options to hedge your portfolio, you're dug in and you're basically eliminating the emotional decision-making process when you are hedged.
I would certainly love to get a G.I. Joe with Kung Fu grip for Christmas. That would be a fantastic Christmas present. So that would make my year. But yeah, you're right. It is an interesting year going into it this year. A lot of things on the horizon that we know quantitative easing finally going to be lightening up. Fed finally probably raising rates maybe sometime in 2015 for the first time in the better part of at least a half decade or so. So things we haven't talked about a lot in the past 5 years or so, things like ROE, of course, and options sensitivity to interest rates may become back on the horizon a little bit. Probably not that much in 2015, but we'll start talking about that forgotten vega, the forgotten fifth variable, I should say, the forgotten fifth Greek out there. We always talk about delta, gamma, theta, vega. Don't really talk about ROE that much. It may become part of the conversation again into the end of 2015 and certainly beyond if rates continue to rise. And just in general, going into 2015, we are, of course, pushing all-time highs, record highs in all of the major indices and a lot of the broad equity products. So a lot of people out there very wisely are starting to be perhaps a little bit concerned about a near-term retracement, a correction, perhaps even worse in the marketplace. If you do fall into that mindset, if you're concerned about that, well then it is a perfect use case for you to start utilizing options to hedge those portfolios. We've had many shows. I encourage you to check out our archives on the defensive use case of options, constructing collars, put spreads, protective puts, all that sort of fun stuff. I encourage you to check all those out in great detail because those are certainly strategies that you should be aware of going into 2015. And remember the rule of thumb we've discussed on this show several times. People always ask, how much should I be willing to pay for these puts? And it depends, obviously, on your product and the volatility skew and the level of volatility. All those other things are going to have a bearing, really, on the cost of those puts. But puts are usually have a premium to calls and all the products you're going to be trading, at least from an equity and index product perspective. Not so much in oil. We can get to that on another show. The rule of thumb is generally about 1.5% to 2% for somewhere around anywhere from 3 to 6 months of decent near at the money to out of the money protection for your portfolio. If you're willing to pay about that amount to hedge your gains, and you should be comfortable constructing something. And again, we've recommended a lot of tricks to mitigate the cost of that. Of course, using put spreads instead of just puts, constructing collars to mitigate the cost of those puts. There's a lot of things you could do. But of course, this might be an interesting time for you to start thinking about those if you're sitting on some gains and you want to indeed protect them. Randy, this is clearly in your bailiwick because that's what you guys do all day long. You construct overlays and attempt to mitigate the cost of protection. So what would you have to say to our listeners on that front, those of them out there who are perhaps starting to get a little bit worried about the markets being perhaps a bit top-heavy going into 2015?
Well, I like I said, strategically, we always say that we hedge portfolios and we try to mitigate the cost, as you said. And so we're not in the business of trying to say, let's hedge or not hedge. We're always hedged. So I look at it and say, everything else being equal, I'm excited to hedge portfolios and re-hedge portfolios at these levels, not know what's going to happen in the future. But everything else being equal, I think it's a pretty exciting time for the markets. On a personal level, as you get closer to the end of the year, I always want the market to kind of hold up to the end of the year so I could re-hedge at the highest possible level and then have things fall apart after that. But we'll see.
That would certainly work out well, I think, for your planning if that were to come to pass. But it is an interesting time in the marketplace. A couple other things I would like to throw out there before we wrap up here to keep in mind for 2015. I mentioned earlier on the show the volatility of volatility, something to be cognizant of. We've seen products like VIX, which is a pure volatility product, exhibit remarkable volatility. I know that's a strange concept for a lot of people to think of, that volatility has a volatility, but it does. Just look at the VIX chart and you can see that for yourself, or look up products like VVIX, which is indeed the volatility of VIX. And you can see for yourself how much that product has been gapping all over the place lately. Something to keep in mind if you're trying to think about constructing hedges in either the S&P or indeed in related products like the VIX and others, that implied volatility is going to move around, and sometimes with a great deal of gusto. So bear that in mind when you're constructing hedges and putting on spreads and trades in those products. It's not something we talk about a lot, but it's something that is certainly worth considering. And in addition, a lot of you out there have written in and discussed issues with the fragmented landscape for options. And unfortunately, it doesn't seem like that's going to get any better anytime soon. We have a dozen listed options exchanges in the U.S. right now. It's going to be a baker's dozen in Q1 of 2015. We're going to have 13 listed options exchanges, all pretty much trading the exact same products. So all those problems you may have encountered in the past, trying to trade multi-leg spreads on a variety of different spread books and things, those will still be there in the marketplace through 2015, I'm sad to say. So no developments, no improvements on that end. But I don't want to end on a negative note, so perhaps we'll wrap it up there, and then we'll move on to looking ahead for what you guys are up to here on the show as well. Perhaps we'll start with you, Mr. Kavanaugh. What can our listeners expect from RCM in 2015?
Yeah, we've, what they can expect from us is, we take a very systematic approach. We don't make any rash decisions. If you do have one of our strategies that employ options, it's kind of like Randy said. We stay the course. Probably our biggest challenge, I don't know if challenge is the right word, our biggest hurdle is just the education to make sure that investors understand what to expect when the market stays flat, when the market goes up, and when the market goes down. So from what lies ahead in 2015 is we're like the Maytag repairmen. We're here, we're steady, we're always at the desk, and we're going to deliver the same message we always do, and that's just to keep the emotion out of the financial decision-making process.
So I can call you when my washing machine breaks? That's what you're telling me?
Well, you could call me when your washing machine breaks, and then we probably won't be able to help with that. But I could probably connect you with somebody that could fix your washing machine.
So you can get me a G.I. Joe with Kung Fu grip, and you can fix my washing machine. You're a handy guy to know these days.
Yeah, well, I'm at the desk right now, and they're all pointing at Dr. George here that they think he can fix the washing machine as well.
Good to know. Good to keep in mind going forward. And Randy, obviously you guys have just gone through a very large rebranding of the firm from Swan Wealth Advisors to indeed Swan Global Investments. I think that gives us a little bit of a peek into what you guys are going to be up to in 2015, a much larger, a much broader purview than you may have had in the past. But I don't want to put words in your mouth. Why don't you go ahead and tell us what you guys are planning, what you have in store for 2015?
Well, the first thing that I can actually announce today is that we're striking NAV on our second mutual fund. So it's going to be emerging markets version of the defined risk strategy that we have based on the S&P 500, which is, of course, our flagship strategy and fund. So we should be striking NAV today, and we want to be launched before the end of the year. So we're pretty excited about that, and I absolutely expect us to have several new mutual funds next year that we launch. I can't give you the exact deadline, obviously, at this point, but we're pretty excited about moving forward. And going along that same concept that we had talked on previous shows of taking the defined risk strategy and applying to different assets, under the expectations that we can get similar types of returns, and ultimately offer our clients various strategies or various products to complete and help build out their portfolio. So we're pretty excited about moving forward on that. And yes, we definitely are trying to rebrand Swan to be much more global and much more broad in terms of the products that we offer to our clients. And the demand we're having right now has been pretty good on the upside. We've got a lot of demand building for the emerging market product as well as other things that we expect to launch in 2015.
Well, congratulations on the new fund. That is certainly very, very big news. We're looking forward to seeing that unfold in the coming year. It sounds like you guys have a lot of interesting things that we'll keep an eye on in 2015. If you'd like to learn more yourself, listeners, surf on over to swanglobalinvestments.com. You can learn more about the mutual funds there, the overlay, defined risk strategy, things we've talked about many times on this show in the past. You can find out how to get in touch with these guys if you want to learn more about all the fun stuff they have going on over there at Swan Global Investments. And on behalf of Randy and Mike, and of course myself, I want to thank all of you out there in the listening audience who joined us throughout 2014, made 2014 such a great year for the Advisors Option Program, and we'll look forward to more exciting shows coming up in 2015.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.